Okay. Welcome everyone. Thanks to us for joining our session, the Alliance of Angels webinar today. We're going to be talking about 10 trends every angel investor needs to know in 2022. And we are greatly privileged to have Bill Bryant, General Partner at Threshold Ventures, to share his insights with us today. Right. And just before we go in, just a bit of logistics. Again, this is a standard Zoom call. Anyone can jump in and participate. So if you have questions for Bill, you would like to react to some of his comments, please feel free to jump in. We want to keep this kind of like real fun and interactive, right? I think it helps and have a great experience for everybody. But that said, we also ask that, if you are not speaking, please put yourself on mute, just as a basic courtesy to everyone, right? I'm sure your kids are cute, your dogs are adorable, but they don't need to be part of our session today. All right, so before we go ahead, I'm going to share a little bit about my organization. I run something called Alliance of Angels. This is the angel investing group here in Seattle. We have 140 angel investors in the group. Every year we put about 10 million into 20 companies, give or take. Right? Most companies that are fundraising from us, they're looking for somewhere between $500,000 and 1.5. And our typical check size is 250 to 500. Right. So again, if you are an entrepreneur, if you're interested in approaching us for fundraising, feel free to send me a note. My email is right here on the bottom. We are, as a group, also sector agnostic. We do maybe about a half IT, a quarter consumer. The rest is life sciences, hardware, energy, etc. But I guess our hard filter is that we focus on the Pacific Northwest. Right, that's really kind of where we're looking for the best founders, the best people in our community, and we do our best to help them. And so again, if you're an entrepreneur, maybe you're an angel today, right? This is more of an investor topic that we have our session today, and you're interested maybe getting involved in my organization. My email's at the bottom of this. Feel free to send me a note. Happy to share a little bit more about my group. All right, and with that, I'm stop talking. And again, we have, if you're not speaking, please put yourself on mute, right? So again, we have a good experience for everyone. And I'm going to hand the session over to our speaker today, Bill Bryant from Threshold.
Okay.
Yep.
Well, thank you, John. It's really great to be back with the Alliance of Angels. As John knows, we used to do a kind of a regular State of the Union moderated talk back circa 2019, and we did it for 3 or 4 years, but this is the first time I've had a chance to see all of you in the last couple, and it's a good time to be talking because the last 2 years have been so momentous in terms of change in the venture capital industry, and I wanted to share some of the observations and data that this talk forced me to go back and look at. So I'm really excited to be sharing with you. And first of all, although the title says 10 things you should know, 10-ish things, it's up to 15. So you're going to get a 50% boost in what we're sharing. And as I confessed to you, John, throughout COVID, in the venture capital industry, we don't present, we get presented to. So this is actually the first time I've had to present a document. I wrote out my material in Word, was going to convert it to a PowerPoint and graphics and all that, but didn't have time. So I'm simply going to bring up a Word document and kind of going to scroll through the points as we go through it. If you have questions, feel free to jump in and ask those. There's a chat window too. Yi-Jian is going to monitor that a little bit for me and ask the questions if I don't happen to notice. But we do want to, in the past, we would be in a room, you'd all be there. It was highly interactive. You'd raise your hand and it was just a ask me anything kind of format. So I want to try to emulate that as much as we can in the virtual world, remote world here that we live in. So without further ado, I'm going to share my screen and let me see if I can find the document. Where is that document? Oh, there it is. Okay. So everyone see the screen? Okay.
Yep, looking good.
Good. Okay, yeah. So what I'm going to share over the next 45-ish minutes, we're going to leave some time at the end for Q&A as well. But 15 things that I think every angel investor really has to understand and know about venture capital as we get into deeper into the year 2022. And I'll start with the obvious. COVID has absolutely impacted every single sector of the economy. You can't name one. Hospitality and travel, obviously, retail, services, food and beverage. you name it, manufacturing, supply chain issues, entertainment, et cetera. And venture capital was no different. There's been more structural change to the venture industry over the past 2 years than in the prior 24 years, dating back to the dot-com era. Seriously, there's so much to talk about with respect to the venture capital industry, which generally is reluctant to change anything. But in the past 2 years, market forces have resulted in a lot of change. So it's critical, I think, that angel investors who are at the very beginning of the capital formation food chain understand these changes and how these changes will continue to impact on startup financing. The first, and by the way, I'm scrolling, so I'm not going to be able to see anybody's hand raised or anything like that. So go ahead and shout out if you have a question. So we'll just start with the magnitude of the industry. Last year, 621 billion venture dollars were invested worldwide. That's just an incredible amount. It more than doubles 2020's number, which was a record in and of itself. 308 billion, and I've got some data there that says, 2016 we're at 69 billion. And so you can do the math. It's like a 8x increase in 5-ish years. About half of those dollars were invested in the US and half were invested in the rest of the world, with certain areas like LATAM and Southeast Asia really accelerating for the first time, becoming very relevant geographies for venture investing. And again, to put the pace in perspective, the quarterly pace of around 155 billion last year exceeded all other full years other than 2019 and 2020. So it's just, a remarkable acceleration of venture investing. But I want to note here at the start that 2/3 of the venture dollars were invested in Series C rounds and later. And that's a relevant stat. We'll come back and talk about specifically about the pre-seed and seed stages, but 2/3 of the dollars invested in Series C rounds, and there were over 600 rounds termed mega rounds that raised 100 million or more in a single round, including a handful of $1 billion and $2 billion rounds in various companies. So point is, 2/3 of the investment dollars are much later stage. That still leaves several $100 billion going into pre-seed, seed, Series A, and Series B investing.
But if we take, that means there will be kind of dedicated.
I didn't get that.
No, keep going. I think someone just accidentally had their.
Oh, okay. Okay. All right. So I want to take a look specifically at seed investing, since I suspect that's the stage that most of you are participating in, maybe some pre-seed, maybe some Series A, but likely as angels, you're looking at seed investing as the core of what you do. So Crunchbase data, and by the way, there are several sources that I'm pulling from here. Crunchbase, PitchBook, CB Insights are the 3 primary ones, and they do a really great job of capturing and aggregating the data for the industry. But Crunchbase data for 2021 indicated that seed investing amounted to about 12.8 billion, nearly 13 billion, went into 8,000-ish seed stage deals. So you do the math, it's 1.6 million per deal. Now, I'll note that Crunchbase data is skewed toward reported deals involving a known fund. And we'll talk about that a little bit, because it turns out that 10% of all pre-seed deals are 50K and under, for example. They're not reported on Crunchbase. We'll look more granularly at this investment round size, but in aggregate, 12.8 billion went into about 8,000 seed stage deals that were reported and had typically a venture fund or two involved. And that contrasts, that was up about 30%, 35% year on year. So 2020 seed activity was about 9.5 billion. Overall, if we look at just at the number of companies that are being backed, the seed and pre-seed opportunities really expanded at a rapid clip. Again, according to Crunchbase, there were over 23,000 individual companies that raised pre-seed or seed rounds in the 5 years between 2016 and 2020. And that was up 30% sequentially over the prior 5 years, and up about 7x if we take a look at the period from 2006 to 2010. So kind of a 7x increase in a decade. It's just pretty remarkable that there's been this primordial, explosion of pre-seed and seed rounds. I always think about, Washington is about 2% of the US population. So you can do some easy math. It's about, we represent about 2%. So if we're proportional, we would have roughly 500-ish seed stage companies that raised in 2016, 2020 out of those 23,000. So, just to put our little part of the world in perspective, we might have seen about 500 seed deals. And by the way, that the comparison for the 2016-2020 period was 6,800 Series A funded startups. So, about 4x or 3.5x more seed deals than Series A deals. Turning to the fund side of the equation, at the end of 2020, there's a really great list on the web. If you Google, seed funds, you'll find it. But there are now over 800 seed funds that have over 40 billion in total funds raised, and they have invested in over 40,000 portfolio companies. So the seed funds are absolutely everywhere. Top 5 states are there, as I note. California has about half of them, followed by New York, Massachusetts, and Illinois. And we'll see, I think we're significantly underrepresented here. If you talked about, if we're 2% of the US, we should see, 16-ish seed funds here. There are not 16-ish seed funds, so we are underrepresented and undercapitalized relative to funds themselves. Okay, so in 2021, that we saw the debut of the 500 million seed fund. So for the first time ever, seed funds have traditionally been considered between 25 and 100, maybe 125 million, something in that range. That allowed the fund to efficiently invest in a portfolio of 25 to 30 companies, and divide that into the fund size. That would be their average commitment per deal. But for the first time, we saw reports of $500 million seed funds being created by Greylock. In particular, NFX raised a $450 million seed fund. They have been historically one of the traditional seed fund investors, and they were raising fund sizes in the 100, 150, 200 million. And then they announced last year their $450 million seed fund. And there are a number of other investors that I've noted here that raise seed funds in excess of 200 million. So I think we can all appreciate that this is going to make traditional seed stage check writing a challenge. You just simply cannot invest a $500 million fund, $1 million at a crack. You can't track, you can't do diligence on, 500-ish companies. And keep in mind, many of the funds here that I list are what are called platform funds. So Greylock, Andreessen Horowitz, Lightspeed, Sequoia, Index, Thrive, et cetera. They're called platform funds. And in other words, when they are participating in the Series A's and B's and C's, they're writing that from a different fund, not the seed fund. So this is 500 million specifically for their seed fund, and they would raise another 800 million or $1.5 billion or something like that to participate in Series A's and B's and C's. So this is going to have a huge impact on seed stage investing. You can easily predict that that rounds are going to increase markedly, where, you know, the Greylocks of the world are going to want to invest, you know, 5 to 7 million, let's say, or more in a seed investment. And consequently, valuations are also going to have to adjust, because the entrepreneur is not going to want to accept that dilution at historic seed stage levels. So this alone, I think, is probably the single most important factor to really understand and evaluate, and how you navigate the rise of these mega seed funds that are going to push out historic, you know, angel investors and the small seed funds and all of that, because they're going to give they're going to make offers of more money at the same dilution to an entrepreneur, or less dilution. And of course, the entrepreneur is going to, you know, they'd rather raise 6 million at the same dilution than $1.5 million. So this is a really important change in the venture industry to kind of absorb and understand how you will you know, find the right opportunities for that, where you can still write a you know, 50 or 100K check. I'm going to pause here just for a moment, because I know it's a little challenging because we've got some more materials, but just take any initial questions on any of the topics that we've covered so far.
And this is a regular Zoom call, so, you know, feel free to jump in if you want to speak up, or if you want, you can also send a note to chat, whichever you're more comfortable with.
And Yijian, it looks like there are a couple of questions in the chat. Is that right?
No, they were just comments.
No comments.
Well, there is a question now. So, you know, it's from Magnus. Why do you think Seattle is lagging in seed funds?
Of course, Seattle's leading seed funds.
Why is Seattle lagging?
Oh, why is Seattle lagging? You know, great conversation topic. You know, people that have the desire to go out and raise a 25, 50, $75 million fund. Now that said, we have had, you know, the Ascents and Flying Fishes and Fuse is doing pre-seed and seed investing, and those have come to the forefront in the last year and a half. But it took the initiative of fund managers to go out and say, I will go out and raise a seed fund, and that, you know, that just hasn't happened so far. I mean, you have any other, in short, I don't know why. Yijian, who's, you know, watched the venture landscape for a long time as well, we have never had enough early stage capital. And early stage capital is what's critical, because, you know, late stage capital is fungible. It will go wherever the opportunities are. It doesn't, you know, really matter that much to our growing companies that Seattle lacks a late stage investor or 2 or 5. That money comes up from San Francisco or New York City or Chicago or, you know, Atlanta or wherever the funds are located. But it is meaningful that we have never had, you know, we don't have a Union Square of Seattle. We don't have the first rounds, you know, here investing in the area. And we just don't have enough of them. I know that, you know, there's the Oregon Venture Fund, and there's this, we talked about some of the other seed investors located here, but there are not enough given the number of, you know, opportunities. Any other thoughts before we continue?
So, hey, Bill, so this is Lynn McMurran. So is it better then to think maybe on the other side is that maybe we should be growing more entrepreneurs as opposed to growing seed funds? Maybe we should be growing more entrepreneurs who are worthy of seed funds. You tell me, what do you think about that?
You know, there's so many programs here in Seattle to promote entrepreneurship. I mean, you know, we have the the Techstars of the world, and AI2, and Pioneer Square Labs, and Madrona Labs, and plenty of programs in and around the UW for student entrepreneurs. So I don't think there's a paucity of initiatives that are aimed at building, entrepreneurs. John Seacrest has a program to try to train up investors, and he's had some success. I think the Flying Fish came out of that program. So it's really more a function of, we need fund managers who have experience and understand how funds get structured and understand how to raise funds from family offices and at some point institutions. The challenge with fundraising is, a first-time fund, you're raising it from friends and family and maybe a few family offices, and it's arduous work. You're talking to many potential backers in order to raise a $10 million fund. For example, like Female Founders Alliance, Graham and Walker, that they really worked hard to get to their 10 million. It took them over a year to get there. So it's hard work to raise that first fund. You have to have the commitment to see that fund and another fund. Nobody wants to invest in a one and done fund. So you have to find fund managers who are, probably in their mid to late 30s, early 40s, who are committed to investing for 2 decades of their life, at least 2 funds, at least. And that's just hard. You got to have somebody coming up the ranks from an Amazon or Microsoft, plenty of good contacts, decides that they'd like to give their take a shot at investing, and drops out of the corporate scene and spends a year to 2 years of their life trying to raise that first fund. That's a small audience, small population.
So, Bill, based on everything that you are saying, the first reaction that comes to my mind is that I should be talking to other angels so we can essentially pull together and create larger seeds. Is there anything else that is an obvious response to all of these trends? Because I won't be able to diversify enough if I have to write 150 or higher checks, even if that would be sufficient.
I want to come back at the very end, because that is absolutely the first and foremost thought that I have, is that the days of individuals investing capital are coming to an end. I mean, they're not coming to an abrupt end. Will continue, but with the round sizes and all of that, there's just no place for a $50,000, $60,000, $80,000 check anymore, unless it's your good friend and they need a little capital to get going. The best entrepreneurs are going to raise some number of millions of dollars, and those are the only deals you want to be in, with the best entrepreneurs chasing the most ambitious and best ideas. And so that's good. We're going to talk extensively about that, because it's something I've said in the past to this audience, that I really wish that groups of angels would come together in a fund and really amplify the power of their checkbook and get diversification as well. So we're going to talk about that. Let's come back to that. Okay.
Thank you.
All right. So, with more capital in the market, the natural consequence is just higher valuations. And I just wanted to provide some data on this. The average valuation, this is PitchBook, that says in the US in 2021, the average valuation for seed stage companies was over 15 million. Median was 12.3. So obviously, some outliers there. And that's roughly doubled since 2015. So just to put some hard facts on it, as and I didn't say, I'm assuming this is kind of a post money, but it didn't say if it was pre or post. But that's pretty extraordinary, because I remember when I started angel investing back in the late 90s. Angel investing sort of started back then in kind of the 96, 97 kind of time frame. And, valuations were 3 million and 4 million. So it's kind of stunning that the same stage companies are achieving these valuations, but it's a consequence of raising more capital too, because seed deals are no longer 500,000, they're, $1.2 million, they're $1.8 million, they're 2.8. So more money is going to mean higher valuations. Series A, if you turn your attention to that, at least in the first half of 2021, was 42 million. And there are many reports, and I see this in our fund threshold, many reports of 100 million, plus. A very typical deal, a Series A deal now is 20 million on 80 to get to 100 posts. And that's just 20% to the round. And, so that's amazing to me, that both the amount of money that is going into a typical Series A, which 10 years ago might have been 6 or 8 million, is now 20 and 30 million. And then the valuations are incredible. I was talking with I don't know the name of the company, but there was a young startup that raised a Series A at 1,500 times revenue. 1,500, so staggering. And on seed valuations, I couldn't really find any good data other than the aggregate data, but I do know that deals are being done at 40 and 50 million pre now and it's really what these investors are buying is an option, going back to the large funds. So you're a Greylock, okay, you're inured to valuation. You don't really care what it is, your going in valuation. It does not matter. What it is an option to invest a lot more capital at the Series A and B and C stages, where they will, the weight of capital is more important than the valuation. So it may sound really weird, but the venture investors operate on a kind of multiple of cash going into a deal. And they'd rather, I'm going to do this off the top of my head, but they would rather see a, let's say, a 2x on 30 million into a deal, okay, 60 million total, than a 10x on, 2 million. Even though the IRR is obviously much higher, they need to return these multi-hundred and multi-billion dollar funds back to their investors before they're going to participate in carry. And so the objective is to place vast amounts of capital and get a 2, 3, 4 times their money, rather than a small amount of capital that would get a 10 or 20 or 50x. Does that make sense to people? So it's become a lot more about tonnage going into a deal, and the deal obviously has to exit well, but it's more important to get tonnage into a deal than it is to get a low valuation and a very high multiple on that investment. And yeah, here's, so to put perspective on initial valuations, if you're seeing a sort of 100 million round on a seed deal, in order to get that once benchmark 10x return that suggested a great investment, that seed stage company would have to exit at 1 billion without any further dilution, which is kind of crazy. Another way of phrasing what's happening now is that, pre-seed is now the new seed, seed's the new Series A. And I want to say that the data here is highly skewed by outliers and large events. But it's important to understand that, because that's where also the returns are. So while it's true that 60% of seed rounds are under $1 million, 10% are under 50 K, all of that. The rounds that were reported for 3 years from 2018 to 2020, 70% were 2 million or less. But the data says that a growing number are raising what are called in the industry mango seeds. If you've ever opened up a mango, you will understand that term. It is a very, very large seed relative to the size of the fruit. And mango seeds are kind of 5 million or more. And the data that was reported actually this is in early 2020, 6% of seed deals were raising 5 million or more. And undoubtedly, when somebody does a survey today, that number is going to be, significantly higher. I mean, minimum 10%, might be 15%. Okay. And in the Valley, it's not uncommon to see reported $20 million seed rounds. And we'll come back to that because there's a sort of a value trap that I think angel investors fall into, where they say, oh, I don't want to, participate in those. But those deals are raising that kind of money because they are led by the most ambitious, best qualified teams out there pursuing larger and larger market opportunities. And those are the deals that you want to be in. So don't shy away from a seed stage company raising, 4 million or 6 million or something like that, just because they're raising that. Really be thoughtful about, is this an opportunity and a team worth backing? No, I don't want to steal my own thunders, but valuation is the only valuation that makes sense, is that matters to an investor, is the exit valuation, not the going in. Okay, so yeah, there was another study from 2020. The median seed investment amount had increased to 4 billion, 4x the median from 10 years prior. So you said, 2010, the data would have said the median around was 1 million. In 2020, it's 4 million. And I would argue that for a growing number of great opportunities, that number is significantly greater, and the mango seeds of the world are going to be the more important cohort to take a look at. Here's the bad part about investing, and it goes back to the question about diversification. We'll talk about the importance of that, but it remains highly unlikely that any given company you invest in reaches $1 billion valuation. Okay, CB Insights, all companies that raise angel, seed, or Series A for a 6-year span, their conclusion was the chances of reaching 1 billion exit was about 1.2%. AngelList took a look at the 2,600 seed financings that had happened on its platform dating back to 2013, and they said that the chances were 2.5%, which had doubled actually since 2018. So if they stopped at 2013 to 2018, that number was 1.2%, but subsequent to that, there were a lot more, billion-dollar kind of valuations. So the chances were 2.5%. As a result of this, pro rata rights are more important and more valuable than ever. Given that there's a very small number of large exits, all your returns are going to be driven by maintaining some ownership exposure in your winners. Okay, so this has important consequences for your investing strategy that we'll come to in a moment. Now, that said, unicorns are being minted at a greater clip than ever. There are now over 1,000 unicorns worldwide, 600 in the US at the end of 20. This is the number that were added is just staggering. 340 were added in 2021, despite the fact that there were 700 companies exiting by IPO last year, many more by M&A. So, and obviously many of those had a valuation in excess of $1 billion. So there were, the 340 we might have lost 200, and then 340 got added back. By the way, there were 39 unicorns back in 2013 when the term was first coined. The pace of investing by certain firms is absolutely insane. There were 4 firms that participated in over 200 rounds last year. Tiger did 344 rounds. That's just, well, like nearly one a day. And there are many firms that are doing 80 or more, or 1.5 a week, which is, you know, typically a venture fund would make one investment every month or so, maybe every other month. 4 years, you know, of investing, 3 years of investing to get to 20, 25 companies. But now the pace is so great that the number of deals that every fund is participating in is much, much larger. 1,800 rounds, importantly, were led by non-traditional investors, and that includes some of the hedge funds that were above the Dragoneers and Cotus and Tigers, as well as crossover funds and corporate VCs. 25% participation by corporate VCs. That used to be a negative signal in a deal, but according to, again, Crunchbase, the corporate VCs invested 145 billion for about 25% of all dollars came from corporate VCs last year. Now that includes SoftBank and a few others that skew the data, but that's way, way up from where it's been. I'll pause there again and field any questions that people might have. We're kind of getting toward the end. We got a few more points.
There were a few questions from the chat, some from Antonio, right? His question was, shouldn't we as angels pursue instead higher IRRs, right, rather than bigger deals just for the sake of it?
No, well, I'm going to make the argument that the opportunities to get into great deals are going to be fewer and fewer and fewer. Certainly, if you could couple, you know, if you could find companies that are willing to take your 50K and are going to exit at 10 billion, you do that all day long. But the argument is that there's been so much change in the venture industry that the best companies and the best entrepreneurs are no longer going to be raising a 1.2 million seed. Now they may do a friends and family round, and then you have to evaluate your own risk tolerance there, because obviously if funded companies only reach $1 billion at a 1 or 2% rate, the angel or friends and family companies have, I don't know what the percent is, it's maybe 0.1%. Okay, and so it's not, you know, you're investing for different reasons at that stage. But I'm going to make the case that your opportunity to participate alongside a quality seed fund that's leading a, let's say, a $2 million seed at the low end are going to be few and far between, because that seed fund is going to say, no, our fund size is such that we need to do, you know, 95%. We'll allow three of your angels to come in. That's it. Okay. But we, you know, if you want our money, you need to, you know, we need to control the round, or, you know, you offered 75K, you got to drop that to 25K now for the angel investors. Another question, Yijian?
Yeah, a question from John Iolio, and sorry if I'm saying your name wrong. John's question is like, for an individual investor, what's the minimum one should allocate to maintain diversified? Or maybe join a fund, considering the new numbers you're presenting.
Yeah, I'm gonna, you know, so I talk about that in just a little bit, but in my mind, you know, if you're an angel investor and your intent is to invest in 3 companies over the next 5 years, that's what your pocketbook allows. And let's say you're going to put 50K to work on each, or 60K, approximately 200K is what you feel comfortable investing. I would strongly encourage you to go find a a pre-seed or seed fund and invest in that fund and not make the direct investments, because just statistically, all three of your investments, anticipated investments, are going to be dry holes. And it's just, I mean, I don't think there's so much serendipity and luck and timing and competition issues and all of that lead to large exits. And unless you've got some supernatural power, and if you do, you should absolutely create your own fund. You're able to pick out the eventual winners when it's a 6-person startup with a couple of customers and all of that. That is the odds are very high against you that company will succeed. So we're gonna talk about that, because I think that's the most important conclusion, is that as an angel investor, you really have to have shots on goal. Okay, you have to have shots on goal. Some have argued that you need to have like diversification to like 500 companies exposure in order, and it's still, the math still works because of this point here, that the exits are trending larger and larger. The markets that companies are chasing are just larger and larger. So if you're in one of these, even fractionally, okay, it more than compensates for all of the other deals that that didn't work out. So I've talked, and this is a little bit off digression, but I've often said that the dirty secret in venture is that 6 or 7 out of 10 deals fail to return capital. These are professional investors with doing strong diligence and lots of experience and all of that. And even the best of us, I mean, Sequoia aside, a few others aside, we whiff on 6 or 7 of our investments, fail to return capital. A couple return small multiples of capital, 1.5x, 2x, great, but doesn't move the needle. And it's that 1 in 10, or 1 in 10 defines a great fund. 2 in 10 just defines an extraordinary fund. If you have 2 out of 10 of your investments exiting at material amounts, significant amounts, you're a top decile, certainly top quartile, but top decile fund in all likelihood. So it's really participating in the large outcome that makes a difference to investment returns. There's well-known power law that if you look across hundreds and hundreds of investments, only a couple make the difference. And the good news here is that the valuations, exit valuations, are greater and greater. So at the end of February 22, there were 15 startups that were valued at 20 billion or more, okay, led by TikTok, ByteDance at 140 billion, but there are many others and many more to come. I mean, I didn't do the enumeration, but if there were 15 at 20 billion, there were probably 50 at 10 billion, and 200 at 5 billion or more. So the returns are going to come by participating in a company that gets to a very, very material exit, and not one that that has a minor exit. We'll take another question, Yi-John.
Yeah, question from Magnus. He wants to know what's the typical return of like a really top fund, like a Andreessen Horowitz.
Yeah, the returns for and again, this is skewed by, if you have like Facebook in the portfolio, the returns are crazy. They're over 100% IRRs. But a top decile fund would be 35 IRR.
Okay, thank you very much.
35 to 40 maybe.
Thanks.
And a good fund would be, in the low to mid 20s. below that, you're not competing with public market returns. So.
Thanks.
Anything else? All right, so I just wanted to talk about sectors for a moment. So dollars continue to flow toward traditional investment sectors, SaaS, software, healthcare, fintech, but a number of new sectors have emerged over the past several years. And here the data is a little bit concerning relative to Seattle's future. I'll talk about that in a moment, but if you look at crypto and blockchain startups, they attracted 33 billion, and there's much, much more to come because over the last 18 months, we've seen multi-billion crypto funds being raised by Andreessen Horowitz, Sequoia, a woman named Catherine Hahn, who was at Andreessen Polychain, raised a $2.5 billion fund. So there were probably last year alone, I don't know, 15 billion raised by billion-dollar plus crypto funds. So there's going to be a lot more investing happening in crypto. Climate tech attracted 37 billion. That was a failed sector from 10 years ago, but given the concerns we all have around climate, is back on the forefront as an area of investing. Space gets a lot of attention, reached a record 14.5 billion. The metaverse, you know, VR, gaming, that sort of thing, attracted 10 billion. And then Meta invested or reported 10 billion in addition. So that's attracting a lot of attention. Robotics, hot space. COVID underscored the chinks in the supply chain. And so lots of investment in supply chain software. And then cybersecurity continues to be a strong, strong area, over 20 billion. Now, looking specifically at Seattle. So we're an important center for venture investing. We came in tied for 5th with Denver at 2.5 billion, but well behind the Bay Area, New York City, Boston, LA. And we ended the year with 10 unicorns, despite graduating several to public status. But I would argue that over the last 5 years, we have lost relative ground to New York City in particular. New York City used to be ranked behind us in terms of investment dollars. It's now a solid number 2, mainly on the backs of crypto and fintech and some e-commerce. But also Austin, Miami, and even Chicago have gained relative ground. Chicago has more unicorns and more funds than Seattle. Excuse me. So, and if you also look at the fastest growing investment categories that I alluded to earlier, we have few entrants. We have a lot of enterprise software. We have a lot of prop tech. We have a lot of e-commerce due to Amazon, but we have work to do as a community to foster startups in some of these other areas like ESG and cyber and crypto and so forth. Pause once more for questions before we go into the learnings and advice.
It's a question from Milton, right? How does one keep up with subsequent rounds when the raises get larger and larger? Given that pro rata rights are limited to usually the bigger players in later rounds? Yeah,
understand. Well, I mean, if you're participating in that seed round led by a venture investor who has negotiated for pro rata rights, you will receive that as well. So it's not only going to now later on, they will, there may be limitations, but at the seed round, if you're participating alongside participating in, the best way to participate would be to be an investor in that round, okay? In that fund, I'm sorry, in that fund, but you will get pro rata rights. We're going to talk a little bit about how do you participate, because I don't think you do participate certainly after a Series B, and you'd like to invest. If you're a pre-seed investor, you want to put in a little bit more money at the seed. and maybe a little bit more money at the A, but no, you cannot participate at the B's and C's because the the dollars get too large. And we'll talk about how do you think about that, because one of the mistakes that angels make is they think, okay, I'm going to invest 75K into this company, and they put that all up front in the pre-seed round or the seed round, and they don't have anything in reserve. And again, what I hope, if you take nothing away from this conversation, it's that your ability to identify true winners is likely limited. So you use the information of a new round to reinvest in a winner, a potential winner, okay, and not put all of your money up front. All right, so here I'm going to go through the sort of advice. There's 6 things I think that I want to comment on, and then we'll open it up for general questions. But you have to be diversified to achieve success as an angel, okay? And by that I mean, if you're going to do it on your own, individual company by individual company, I think you have to have a plan to get to 10 to 20 shots on goal, okay? If you're intending only to invest in a handful of companies, I would say the probability is that they're all going to be dry holes, and you're better off keeping your wallet in your pocket. There was a question earlier about kind of collectively coming together, and absolutely, I'm a big fan of this. I think instead of investing directly at the seed stage, consider becoming an LP with a local seed fund, or starting a small partnership fund of your own with like-minded investors. If you can raise even a couple million, assuming you're not going to take any fees from it, and you're willing to commit to the paperwork for 10 plus years, you can achieve some level of diversification over what you as an individual investor are comfortable achieving. So I think you consider becoming an LP, you achieve diversification, you get better deals because the best opportunities approach funds because they know that they can write larger checks. And yeah, that's very important. To the question about how do I exercise my pro rata rights? Well, you really can't. As winners grow in valuation, that 50K proportional investment becomes a 300K pro rata right. And so what you need to do is invest 60 to 70% of your budget per company in the first round that you invest in. Hold the rest in reserve. Don't invest in a struggling, and this sounds brutal, but if a young company isn't able to attract follow-on capital relatively quickly, you should stay away. And the reason is, don't do bridges, don't do, we just need a little more time, because guess what? There are a lot of companies that aren't needing that extra time and are raising capital from other investors. And, you just have to accept the fact that that deal that's struggling is not going to emerge as a great company. Also, as an angel investor, don't fall into a value trap. Okay. I talked to so many seed investors, angels, who say, oh, that company that I would have done it at 5 million pre, but 8 million is just too much. Okay. You got to get beyond that. You got to say, does this company have an opportunity to become a iconic, enduring company or not? Okay. And if the answer is yes, then you want to get into that deal regardless of valuation. It does. I really don't understand angel investing that says a deal is good at, again, at like 6 million pre, but terrible at 10. It does not matter. Okay. What matters is the exit valuation, not the entry valuation. Okay. You have no idea what the exit environment is going to look like. So don't be dissuaded by a deal that you think is overvalued. Yeah, valuation gets determined at exit. Pace yourself. Angel investing is a long game. They take a long time to reveal themselves. And finally, the best deals really don't want or need you as an angel, as an individual angel, because the bulk of their capital is coming from a fund. And so as angels, if you want to continue to invest directly, you need to up your game and demonstrate that you're more than money and you can be helpful in some small way. So those are my remarks. Yijian has this, and you're welcome to send it out. And if people want to review the materials, I'm going to take off my screen share. And open up for questions in the few minutes we have remaining.
We have a question from Milton, right? The vast majority of companies are acquired at 40 to 60 million. I mean, that doesn't suggest that the starting valuation, doesn't that suggest what starting valuation you should accept to get a reasonable return for your risk, given that most outcomes are 40 to 60?
Yeah, and if certainly if the company is if the company raises 2 million and exits 2 years later at 40 or 60, that's a very good return for an angel investing. But I would, again, that profile of a company, it doesn't suggest a company that is addressing a market with a differentiated technology that can get to the many billions or billion or high hundreds of millions or whatever you want to use as a threshold of valuation. And that's where 80% for sure of returns are generated, overall returns, not from the small M&A market. So you're correct that the majority of exits are through M&A, no question about it. 75, 80% of all exits are M&A. And yes, statistically, your data, I remember a couple of years ago, I remember seeing like 71 million was the average exit size. But those don't drive returns for you, and here's why. Again, your ability to pick a company that's even going to exit at 60 or 70 million at the very earliest stages is very limited. You have no idea. It could exit for 0. It could exit for $1 billion. You're not sure. It's you're playing kind of a stochastic random process, and that's why it's important to broadly diversify. So again, other people can have different thoughts, but I would say entry valuations are not the key. Exit valuations are what's important.
Okay, Bill. So we're actually at time. It's 12 o'clock. So we really appreciate you spending a full hour sharing all your wisdom and your advice with us. It's greatly appreciated. And several people have asked for your notes. Just again, I think you said it's okay for us to send it out. Can you confirm that?
It's fine. Yeah, there's nothing proprietary at all. Yeah.
Okay. Wonderful. All righty. So again, thank you very much for your presentation. And also thanks to everyone who joined the call today for participating and sharing their questions. And it's been a great opportunity to learn together. Thank you.
Yeah, thank you, everyone. And I look forward to doing this in person at some point.
Wonderful. All right. Everyone have a great
Sounds
week.
great. Thanks a lot.
Thank you.
Great job, guys.
Thanks.
Thank you. Have a great day.
Thank you.